Hello there. Welcome to the Open right here on BNN Bloomberg. Let's get to the big stories we're bringing you from our newsroom. March home prices in Toronto fell to their lowest level in more than 5 years, according to data issued by the Toronto Regional Real Estate Board. The benchmark price of a home in Canada's biggest city dropped 0.6% from the previous month, hitting the lowest since December 2020. So home prices declined and the supply of listings remained elevated. However, home sales in March did increase for the first time in 6 months. Billionaire activist Bill Ackman is proposing a $65 billion U.S. deal for Universal Music. His investment firm is pushing to combine the music giant with a U.S.-based acquisition vehicle. That pitch puts a 78% premium on the Netherlands-based company. The deal would force through a U.S. listing that UMG has so far delayed. The world's biggest music company, UMG, houses artists such as Taylor Swift and Drake. Shares in United Health Group, Humana, CVS, and other health insurers have moved up in the pre-market. This comes after the U.S. government said it will pay private insurers close to 2.5% more in 2027. According to the Centers for Medicare and Medicaid Services, the policy is expected to add up to, and perhaps more, than $13 billion U.S. in additional payments to Medicare Advantage plans next year. And U.S. futures slipping as the world awaits that 8 p.m. Eastern Time deadline on Iran imposed by U.S. President Donald Trump. He says that if that nation doesn't agree to a ceasefire, the U.S. will launch widespread infrastructure attacks. And let's have a look at how the TSX traded yesterday. Off its record highs, but it has been rallying over the past few sessions. Let's check in on oil this morning. No sign of peace in that fighting in the Middle East, and you can see oil jumping now to $115. RBC warning that this is an economic crisis. It's hit Asia already, and it's on its way to Europe in the shape of sharply higher energy prices and even shortages of fossil fuels. And let's have a look at gold this morning. Down slightly despite all this turmoil. Checking in now on the Canadian dollar, which has not been propped up that much by stronger oil prices. You can see our currency right now stuck below 72 cents US. And finally, Bitcoin. It has, of course, lately been trading in line with tech stocks, and you can see not doing much of anything this morning, barely above $68,000 US. So U.S. President Donald Trump renewing a threat to destroy power plants and bridges in Iran if Tehran does not agree to open the Strait of Hormuz, and he wants an answer by 8 a.m. this evening, Eastern Time. There's lots of doubt, though, that any kind of a ceasefire will be agreed. Let's get more from Ryan Dietrich, Chief Market Strategist at the Carson Group. Ryan, great to see you. On the bright side, market historians keep pointing out that often after a war or a global crisis like this, stocks end up higher a year later. But there's a lot of uncertainty in the meantime.
Boy, everything you just mentioned before I came on made me feel kind of depressed. There's a lot going on there. But thank you, as always, for having me back. Let's look at some positives here. Listen, whatever happens tonight, whatever happens in the future, I don't know. Nobody knows. But we do know some things, though, here. Like you said, Andrew, you look back at history. We looked at 42 major geopolitical events, kind of like what we're dealing with right now. Markets down on average a month later. That sounds familiar. But then as you go forward, markets have a real funny way of kind of adjusting to what we're seeing, kind of getting used to what we're seeing. We always say in our team at the Carson, It's not about good or bad. It's about better or worse. Well, listen, there's a lot of worse that's being priced in right there. Maybe we get some type of resolution on the war, or maybe the economy just continues to kind of chug along. We get more into that. But the reality is this is unfortunate what's happening. But if you would have told me crude oil is doing what it's doing, headlines be what they're doing. Oh, the Fed, they're no more hawkish now than they were. Yields go higher. Yet the S&P 500 is down about 3% on the year, and most global markets are actually in the green. I think most of us would have taken that, and that's kind of where we are with things.
It is interesting, isn't it? Yeah, let's put up a 1 year maybe for the S&P 500. Investors do still seem to be, or some of them, assuming that this thing will pass. I mean, this surge in energy prices won't be sustained.
No, agreed there. And I think what's going to drive us, let's say we do get through it. Let's say this bull market continues, which is our base case. I think it's going to be earnings. I mean, earnings season is starting up right about next week or so here in the U.S. What's incredible, Andrew, since the start of the year, S&P 500 forward 12-month earnings guidance is up over 7%. Since the war started, it's up over 4%. Now, most of that has come from tech and energy. But at the same time, we're looking at another solid earnings quarter. I don't think it's not going to. I don't think it's going to change. They're going to see once again better than expected earnings. And one final comment here: profit margins on S&P 500 up to 15%. They were 12% in late 2019. So you have record highs in profit margins, record highs in earnings. There's a lot of bad stuff that's happening out there, but I think those should be things that comfort longer-term investors. And again, reasons that we think the market will eventually work its way back to new highs, probably the second half of this year. But we think it's going to happen, being led by earnings and profit margins.
Let's put up the old 10-year bond yield over the past year, the U.S. 10-year bond yield. You are wary on bonds, though, Ryan.
Well, we have been. I know something I've tried talking to you for a while now. At our team, we manage a lot of money, billions of dollars. And we say if you drop it and it hits your foot and it hurts, you might want to own a little bit more of that. Things like real assets, things like hard assets. We've positioned the money we run for what we call a more volatile inflation world. Not necessarily higher inflation, but more higher volatility on inflation. And for that reason, we're not. Listen, I guess the big surge in 10-year yield, it's a little surprising. We're not shocked, though, that we are seeing higher commodity prices. I mean, crude oil is just playing catch up in a big way, I'll admit, with a lot of other commodities that already went higher last year and the year before that. So to see these higher yields, to see a little more volatile inflation, and honestly, a little bit higher inflation, those aren't things that surprise us. So we have shorter duration bonds. We own bonds. Listen, you manage a lot of money, you're going to own some bonds. But we have less bond exposure. We say diversify your diversifiers, Andrew. In the old days, 60% stocks, 40% bonds. We're probably like 68% equities right now. So what's the rest of the 32%? Listen, we have some managed futures. We have some gold. We have some cash. We have some bonds. We have some real assets. We have some hard assets. We have different things in that diversifying bucket, which clearly has been a big help the last couple of years because bonds just haven't done all that well.
Are you drawn to gold right now? Are you tempted to overweight it?
Well, I wouldn't say we're overweight. We own between 2 to 4% gold probably, and if you look at the different models that we run, but I still think that makes a lot of sense. We still think it makes a lot of sense. Now, what's going to hurt gold is if the Fed turns hawkish, and that's what we've seen with this recent, when all the war started, the realization, well, the Fed's not cutting anymore, or they might, but I'm going to say in the market saying now they're not going to. I don't think the Fed's going to hike. I think like the market does, that pendulum one way or the other, we've swung from, 3 or 4 cuts to, oh my goodness, now they're going to hike. I'm not so sure about that. So again, if the Fed turns hawkish, gold will be in trouble. But I bet they try to kind of change their tune once we get through what's happened in the Middle East, once we get through the spike in energy. And I still think gold and other hard assets, for that matter, make a lot of sense to own a little bit in a diversified portfolio in today's environment.
Because the Fed, if it did hike, it wouldn't really be hiking because of an overheated economy.
No, you're right. They would not. It would be because of the worries about inflation. And that's the big question no one has the answer to. I will say this, though. I've come on with you for a while, and we've said, again, kind of my earlier answer, we think we have a little bit more of an inflation problem. Even before all this started, we looked at 178 components of core PCE that tell us that's the Fed's favorite measure of inflation. 50% of those core components are above 3% year over year. Okay, what in the world does that mean? This time a year ago, Andrew, it was 40%. We talk about market breadth, right? Broadening out. You want more stocks going up. Well, we've been seeing inflation broadening out, and that's something we've been talking about. That's not like end of the world stuff. We're just saying that's a higher inflation world, maybe a higher volatility inflation world. So again, I mean, listen, I talk all day on this to make it real quick. Stocks do pretty well when inflation's higher. And people are like, oh my goodness, inflation. No, I mean, stocks have a funny way of what Delta just say. I mean, Delta, literally airlines in the U.S. saying they had some of their best days ever over the past 2 weeks. So, yeah, they've hiked prices. It hasn't hurt demand yet. And that's the key word. I get it, demand yet. But a little bit higher prices, consumers still can take that. We just had a pretty solid labor market in the or labor numbers in the U.S. Labor market U.S., it's cracking. Yes. Is it falling apart? No. And I think those are things that we can withstand a little bit higher inflation. If inflation goes to 9%, yeah, all bets are off like we saw in 2022. I don't think that's going to happen. But again, we're in a higher inflation world, and that's just where we are.
Always great hearing from you, Ryan. Thank you very much indeed.
Thanks, Andrew. See you next time.
Ryan Dietrich. Up next, oil in focus. We've seen WTI jumping to $115 this morning. We'll hear from Bob McNally of Rapidan Group after the break. Welcome back. OPEC and its allies have agreed to increase oil output quotas by just over 200,000 barrels a day in May, but many consider that to be symbolic, with the Strait of Hormuz still effectively closed to oil shipments and, of course, movement of other vital commodities. We got more from Bob McNally, founder and president of Rapidan Energy Group.
This is an organization, OPEC, that met during long wars during the 1980s, and that they are meeting in the midst of this with Russia included in this group of OPEC plus, I think is still, it's symbolic, but it's important. The most important real world thing that OPEC, or really Saudi Arabia, has done is increase those crude flows over to Yanbu on the Red Sea and provide a little bit of relief from the world's largest disruption now going on at Hormuz. So that's more important than the 206,000 barrels a day quota increase announced yesterday.
Why is that more important?
Volumes. I mean, what matters now is volumes. When Hormuz shut, we lost 20 million barrels a day of crude and products, about 15 of crude, 5 of refined products, LPG. And we were able to redirect, or Saudi Arabia was able to redirect 3.5, maybe 4 million barrels a day, from the Hormuz Strait, where it had been going out, over to the more lightly used Yanbu port on the Red Sea, where there are a lot of tankers lining up to get oil. So that just is orders of magnitude bigger than the 206,000 barrels a day of a quota increase, which is largely symbolic since that oil is really still blocked up in Hormuz.
Got it. Okay, so going back to OPEC then, because obviously, as you say, there isn't capacity right now to transport or store additional barrels. So if there's an increase in OPEC production, could that actually stabilize the markets at all, given all the factors that are at play here?
I'm afraid not. This is such a huge problem, such an unprecedented problem. The only solution to this is to restore the flow of oil and gas through Hormuz, ideally without having damaged critical energy infrastructure, terminals, stabilization plants that so far have been largely spared. That's the only thing that's going to stop this.
And with the Strait of Hormuz closed, like, which countries are still actually producing barrels, or have any countries actually shut in all their production?
Well, so Iran is the only country that is producing at pre-conflict levels, if not a little bit higher, and is no longer sanctioned, and is making money hand over fist, given the high prices of oil in general and the high prices for its grades of oil in particular. So Iran is the only continuing exporter. The rest of those producers, Iraq, Kuwait, Saudi Arabia, UAE, they have had to shut in nearly all their production in some cases, a good deal in others. Saudi Arabia, as I said, is able to maintain production because it's redirected a lot of its crude away from Hormuz and toward the Red Sea. But others have had to shut in healthy amounts of production. And it'll take, in some cases, months, many months, to get all that oil back once the shooting stops.
Right, because I wonder what that production looks like right now, given the damage that's been done to so many of the infrastructure in those areas.
Right. So, well, we have, the deficit now 13 to 15 million barrels a day that has been lost in terms of crude and products to world markets. So, for every country, it's different. Iraq, it's down by many millions of barrels a day. Saudi Arabia, less so, and so forth. But, that can be largely restored. Largely, I say, some fields in Iraq that are old and not able to be cycled up and cycled down, they may suffer permanent loss. But then you have some fields in Saudi Arabia, perhaps, where resting it, if you will, shutting it down, may actually restore pressure and energy and may be more potent when it comes back. So the real issue is the long-term production capacity, which is a function of which fields were brought down, how long, in what fashion, and then what does infrastructure look like when this shooting stops.
And just lastly, I know we were listening to U.S. President remarks today at the White House. I believe you were as well. I wonder what your main takeaways were from what we heard from Donald Trump today. And do you believe the U.S. will actually escalate the conflict if Trump's deadline is not met, that deadline being tomorrow?
Yeah, we're always a little bit cautious because, as we all have learned, the president can say different things at different times. But this time, he appears to be pretty serious about this ultimatum for 8 p.m. Eastern tomorrow night. And while he alluded to talks that were going on, supposedly in good faith, I don't understand that's the case. I wish I had optimistic information on my own side from Iran and so forth that we were moving towards a ceasefire. But I think odds favor, unfortunately, no ceasefire. The sides are too far apart. Iran thinks it's winning. And the president now, I think, to defend his credibility, will have to escalate if he doesn't get a deal by tomorrow. So I'm afraid the odds favor escalation here in the coming days.
Bob McNally, president of Rapidan Energy Group. Coming up, Barrick Mining slowing development of a big Pakistan project amid security concerns. We'll have more after the break. Okay, lots going on. Barrick slowing development of a big potential mine in Pakistan. We were joined by John Ing, CEO of Maison Plasmon Canada.
Reko Dig, Andrew, it's in southwest Pakistan, but it's in Balochistan, which is the province, and that borders Iran, Afghanistan, and it's in Pakistan. So it's definitely near and located in an area where there are currently jets, bombs, etc. And you just don't want to be thinking about building something that big. It's a $6 billion project, up from, I think it was $4 billion. So it's a fairly large expenditure. And I think the logic is that perhaps we should just wait a while and see what develops.
Because they are focused on Nevada right now as they work on the possible IPO of those assets.
Well, it's a long-term project and has been for some time. It is, after all, the prize is there. There's something like 5 billion tons of copper, pounds of copper. There's a 500,000, it could be a 500,000 ounce a year of annual gold production. It's could last 37 to 40 years of mine life. It's a huge project. It's copper, gold, copper, as we know, the world needs it and it will be desperate in the next few years. This project, Andrew, was not supposed to sort of come into production not till 2029. So the price tag has increased. There's expectation that prices itself will likely increase. So it makes a lot of sense to go slow. Important, however, is that Reko Dig is something like 14 million ounces of gold in the ground. And for Barrick, that's a significant down the road. So my guess is that they will keep the project on the stove, so to speak, but it's not one that one would abandon. The risk reward is is too appealing, in my opinion.
There's a lot of moving parts at Barrick these days, aren't there? Especially this potential IPO of their crown jewels, their Nevada and Dominican Republic assets.
That's right. I mean, there is the intention to spin off Nevada goldfields, or a portion of it, something like 10 to 15%. To me, I would want to own more of it rather than spin off some to the public. It is the world's largest gold complex. It is rich in resources. Barrick has something called the 4 Mile Project, which is another potentially 500,000 ounce a year producer outside the project. They could, according to the agreement, flip that into the Nevada gold venture, which they share with Newmont, and in fact make it worth even more from a valuation standpoint. So there's, as you say, there's a lot of moving parts. If I were running Barrick, I would want on more, not spin off less.
Why are they doing that? I guess it's the old financial engineering. They think that those U.S. and Dominican republics will get a big fat valuation.
Well, that's right. I mean, a geopolitical world is so uncertain nowadays. Parts of, as we see, where Reko Dig itself is in Pakistan. Also, there is, Barrick has in Africa, Lumwana. And so all mining companies, other than, say, something like Agnico, have mines in areas of the world that are risky jurisdiction. But frankly, mining is risky itself. There are some institutions which don't want to be in that area. And I think that that's the appeal of a spinoff. Have something that's an all-American, including the Dominican Republic, of course. But my sense is that when you look even at Newmont, which is the world's biggest gold miner, they are in parts of the world where one would not normally want to be or sometimes even visit.
No, that's right. Yeah, what's the old rule? If you wouldn't go on holiday with your family there, don't invest in it. Agnico, of course, you mentioned Agnico. It has achieved this pretty rich value or decent valuation because it's seen as being in safe jurisdictions.
Well, that's right. It's in the largely Canada, Australia, Mexico. It's interesting. Its founder, Paul Penna, once said he doesn't want to build a mine where you can't wear an overcoat. And Sean Boyd then branched out from Canada and put them into Mexico. Also, Agnico has some mines in Finland. But from a geographic point of view, Andrew, Agnico is in preferred jurisdictions, and it produces gold at a big profit, and thus the premium. Sometimes you can't have everything at the same time.
John Ing of Maison Placement Canada. The opening bells are next. Trading is underway, and here are the opening bells. At the Nasdaq, Greenland Energy is doing the honors. At the NYSE, it's TSX-listed Oceana Gold ringing the opening bell. And in Toronto, it's CIBC Global Asset Management and Avantis Investors opening the market. It's time for the first 50. Trading is getting underway as the world awaits Iran's response to U.S. President Donald Trump's latest warning that if Iran hasn't agreed to a ceasefire or offered some concrete proposal by 8 p.m. Eastern Time, he will launch widespread infrastructure attacks. You can see stocks slipping in early trading. S&P down 1/3 of 1%. Let's check out some stocks in the news in Canada. Boardwalk REIT selling 4 properties for $105 million. 3 of them in Quebec City, 1 in Edmonton. The trust also bought back just over 1 million units for $66 million In Q1 of this year, portfolio occupancy remaining strong at 97.1% as of April. And we're expecting Q1 numbers from Boardwalk May 5th. Pembina Pipeline telling investors about its growth plan, talking about the growth trajectory through the end of the decade. It says it's going to make fuller use of its existing network and projects already underway. It expects growth of 5 to 7% in compound in annual fee-based adjusted earnings before interest, taxes, depreciation, and amortization. That's on a per-share basis through the end of the decade. And Desjardins, Jerome Dubray, saying that telecom investors should be wary that wireless pricing wars continue. Some of the offers launched in Q1, the analyst says, rank among the most aggressive we have ever observed. However, it did occur during a low volume period. But this is interesting. It raises the question, Dubray says, of whether such behavior is simply characteristic of a four-player market. And that, of course, refers to the advent of Quebecor as a national player. And nevertheless, though, he does have fairly positive ratings. Look at the rise in Quebecor stock. Dubray, according to my Bloomberg screen, has a buy on BCE, TELUS, and Quebecor, but a hold on Rogers. Citi says investors are being too hard on TFI International. The trucking company reckons it's one of the most overlooked and misunderstood names in our coverage. People apparently see TFI as a challenge unionized carrier. It bought UPS Freight in 2021. And sure, there has been weaker than expected margins, but legacy UPS Freight is only about 20% of profit, Citi says. And finally, McEwen Inc. is a big shareholder in McEwen Copper. And now I think we might have the name wrong there on the screen. It should be just McEwen Inc. I'll check that, but I believe it's just McEwen Inc. because I don't think McEwen Copper is public. But in any case, McEwen Copper is in talks with global lenders as it seeks financing for its $4 billion U.S. Los Azules project in Argentina. And that would be a big copper mine. Let's get some movers south of the border. We are joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities Team. Jeff, thanks very much. Health insurers in the States getting some good news?
Yes, that's right. Health insurers are the top performing stocks in the S&P 500 so far this morning. Definitely worth watching the entire group. As we go through the trading session today, that's United Health, that's CVS, that's Humana. These companies were up 7% to 10% in the pre-market session, moving sharply higher because the U.S. Medicare program is looking to increase the payments that they're making to these managed health companies by 2.48% in 2027. Now, if we kind of roll back the clock a little bit, we'll remember that in late January, these stocks all fell, and they fell very sharply because the plan had been to just hold payments steady to these companies. So on a flat payment outlook for 2027, these companies all dropped. Then Wall Street came out and said, oh, you know what, they probably only need 1%, 1.5%. That was the line from a TD Cowen note at the end of March, 1% to 1.5%, and they should be fine. Well, they got 2.48% today. That looks like it's better than fine in the analysts' view, and on the view of investors, looks like it's better than fine too. These stocks are moving sharply higher so far.
Now, I had to look up this tensor processing units. It's some kind of a device to help AI learn, machine learning. Broadcom is going to be supplying these devices to Google.
That's right. Tensor processing units, or because Google and I think the tech sector just loves acronyms, TPUs. Google is going to be supplied with these TPUs by Broadcom. Broadcom is moving up this morning as a result. A big move for Broadcom, 2.6% in the pre-market session. Worth noting that NVIDIA is actually down today, so this does look like a bit of a win in the marketplace for Broadcom, the chip maker. Also worth noting, both NVIDIA and Google kind of confirmed a partnership deal with Anthropic, which is a big privately held AI company as a result, or as part of this. The street was largely positive on the outlook for this. This is a long-term agreement that takes that exists through 2031. Jefferies analysts out this morning saying that it puts a floor under the TPU market going out that far. So tensor processing unit, again, I've got to admit, what's inside my computer is a bit of a mystery to me, but TPUs, latest and greatest thing.
It is incredible. Even the computer experts, the AI experts, they don't fully understand the reasoning that AI itself does, as I'm sure you've heard. Yeah, incredible. Jeff, thank you very much indeed. Jeff Morgan of Bloomberg.
Thank you.
Coming up, we are going to hear from a market player who says there's reason to feel optimistic about stocks despite the war in Iran. U.S. President Donald Trump doubling down on his threats to attack Iran's infrastructure if that nation doesn't agree to reopen the Strait of Hormuz. We've seen pressure on markets today. We're joined by David Onyett-Jeffries, VP of Economics and Multi-Asset Solutions at Guardian Capital. Thanks very much for joining us, David.
Thank you very much for having me.
So when you sit down with clients, what do they say to you and what do you say back?
Well, so trying to take the long run focus doesn't really sort of scratch the itch for clients. They want to know what's going to happen today, in an hour from now. And looking at a day like today, I can't say with high conviction what's going to happen within the next 12 hours. But we've been to this point before where we've seen deadlines set. We get very close to the brink under this current administration, only to backtrack. And whether or not it's an immediate backtrack or sort of a couple days down the road, we see sort of this sharp volatility as a result of that.
And prior to this, things were looking fairly good. Inflation seemed to be largely under control. Economic growth was okay.
For sure. At the start of this year, it was pretty much the most constructive backdrop that you could really envision at this point in the economic cycle. We had inflation was still above target, but it was well behaved enough that central bankers weren't being concerned. Economic growth was broadening, not just on a regional basis, but across sort of those underlying drivers. Because you look at the last 5 years, it's largely been the U.S. consumer. But we've seen a broadening out, whether it's public and private investment, government spending picking up, and the consumer remaining in decent shape. And then we suddenly hit, a wave of geopolitical events. We have, in January, Venezuela. We have ongoing things with the Middle East now that have popped up and just sort of escalated. And it's really created this fog, this more noise around these underlying signals, which in general are positive in the absence of the sort of the noise.
Right. It does look as though there's going to be a price shock with petrochemicals going up, fertilizers, you name it. So we don't know how long for, though.
And I think that's the big question right now. So the shock really matters in terms of its broad implications on growth and inflation if it's the magnitude and the duration. So let's say by the end of today, we have some resolution, the Strait of Hormuz opens up and we can get the flow of not just energy, but the broad commodity complex, because fertilizers and other commodities go through that strait. We're going to see commodity prices across the complex come down. And expectations for inflation are going to moderate from the relative highs. And we're going to see sort of this shock be more, to borrow this word from Powell that got pilloried for years, transitory impact, right? The longer it lasts, the bigger the impact. But there is potential, especially given the nature of these shocks and what we've seen the volatility of the last year. It could be, next week we could be talking about something else completely.
What about this phenomenon that we've heard of in recent years and the possibility of a rotation away from U.S. assets? Certainly the U.S. dollar has been doing fairly well lately. Maybe we can put up a 5-year chart. But do you think that's a long-term trend?
U.S. dollar strength is actually, I think, an inverse, absent this noise, because a lot of that is the flight to safety of this uncertainty in the marketplace. But if we're looking sort of more long and medium term, and in terms of what we do, that tends to be our focus, those underlying fundamentals. It would appear, again, if we go prior to this events in the Middle East, the weakening of the U.S. dollar was considered the path of least resistance, because we have an environment where the growth premium for the U.S. over everybody else was narrowing. Interest rates where you have the ECB and the Bank of Canada largely standing pat because they're already at neutral. You have the U.S. continuing to cut rates to move more in the range of neutral, and they're still in the restrictive territory. So if you get sort of the narrowing of interest rate differentials and growth differentials, then it's going to be reallocation of money elsewhere. It's not because the U.S. necessarily is a bad investment environment. It's just that the opportunities elsewhere are appreciating at a time when valuations were more attractive on a relative basis.
But we know now that Asia is already experiencing severe economic disruption with even shortages of energy.
Yeah, and that is the problem, right? So if we look at the market performance over the last month or so, it has been not just dumping everything entirely. It's been sort of discriminating, because I almost sort of joke that you can look at the chart of who is dependent on oil from the Strait of Hormuz and for energy, and that majority of it goes to Asia and Europe, right? Whereas on this side of the Atlantic, we're relatively insulated, not only because of the lack of dependence there, but also in general, where we produce more energy than we consume. So we're seeing that play out. And again, it comes down to the duration and the magnitude, right? If we start seeing this scaled back, then the pressure on the Asian economies and European economies due to this oil energy price shock is going to be mitigated. They're going to be worse off, unfortunately, as a result of this compared to North America. But in the longer run, this, again, is going to normalize.
Do you think that this will be good for nuclear stocks? I'm just thinking about Cameco. I mean, I've seen commentary that governments are going to start thinking about, well, how vulnerable are we to hydrocarbons? Oh, should we look at alternatives?
Absolutely. I think the big push towards alternatives is going to gain steam, and not so much, prior to this event and prior to 2025 with the switch of administration, sort of the ESG aspect and getting away from carbon, fossil fuels. It's going to be more about energy security, right? If you are a country that does not happen to be sitting on a huge ton of fossil fuel reserves, you need to look to alternatives, right? And you need to meet those demands. And you can see whether it was the pandemic hit and the impact on supply chains now, or we're seeing this hit in terms of the commodity space, countries are increasingly trying to look inward. And you're seeing government investment to sort of support this infrastructure.
It's interesting. I mean, in the Second World War, Germany and Japan were crippled by their lack of oil. Things don't change in that sense.
Exactly, right? It's because, especially in the post-World War II era, there was this increased push towards global integration, right? And it was, taking comparative advantage economic theory and realizing, hey, we are good at producing, manufacturing sectors in Japan and Germany in particular are quite strong, but we don't have the resources, but we can rely on other countries to provide those to us, right? And so there wasn't this need to develop it because of the low-hanging fruit from growth to just focus on what you're good at. Whereas now we're seeing, as relationships have changed in this 40 years of globalization is starting to reverse course, there's this increased emphasis of economies, and they're putting their money where their mouth is, execution to be determined, but to try and sort of support their domestic infrastructure.
David, thanks very much indeed.
Absolutely.
David Jeffries, VP Economics and Multi-Asset Solutions at Guardian Capital. Yesterday on Market Call, we were joined by Stan Wong, Portfolio Manager at Scotia Wealth Management. And he covered North American large caps and ETFs, his top ideas, Taiwan Semi, Global ex-US electrification ETF. I do love that ticker symbol, ZAP, and BHP, the giant miner. Today on the show, it's Colin Szysinski, Portfolio Manager and Chief Market Strategist at SIA Wealth Management. The topic, technical analysis. Up next, billionaire investor Bill Ackman is proposing a $65 billion US deal for Universal Music Group, the home of Taylor Swift and Drake. We'll have more after the break. Maple syrup season is one of Canada's sweetest spring traditions, but in the Maritimes, consistently low temperatures have been slowing sap flow. And for small producers, that could mean a big hit to their bottom line. CTV's Maria Sarro filed this report.
Inside the Hazel Grove Sugar Shack, owner Greg Beamish opens a tap to a thin amber trickle. The evaporator is quiet. No sap coming in means no boil today. He says so far this is his worst season since starting this small operation more than a decade ago.
I'm noticeably further behind than I normally am. It'll be the first year in 12 years I have such little sap.
By now, he should have about 10,000 liters of sap boiled off. Instead, he's at under 3,500, putting production at about 1/3 of where it would usually be.
If I stay where I'm at, yeah, it'll be a poor year. It'll hurt my pocketbook in the long run.
Maple sap runs best when nights freeze and days thaw. But this spring has stayed too cold in some parts of the country, stifling the flow. In Quebec, producers recently reported running about 30% behind last year's pace. And it's what makers across the Maritimes are dealing with too, says the New Brunswick Maple Syrup Association.
If you did plan some investment to change equipment or whatever, you will need to wait another year.
For now, Beamish closes the lid and waits on a warmer stretch. There's still time for the season to turn, and he's hopeful. But each passing day leaves less room to catch up.
If production doesn't ramp up by the end of April, Beamish says he could run out of maple syrup to sell before Christmas. Maria Saru, CTV News, Rustico, Prince Edward Island.
That's bad news. I want to get out. That's so much fun getting out actually into the maple groves and picking up some maple syrup. Okay, let's check in on the stock market. We'll start off with the TSX, and you can see it is down in tandem with U.S. stocks for the year so far. We've got the American market, the S&P 500, down just under 4%. Toronto is ahead, as you might expect, with decent, strong oil prices and still pretty good gold prices. Toronto is up about 4.2% this year. Let's have a look at oil, because this is ominous, this increase in oil prices. Ominous when good news for Canadian producers, but bad news for central Canada in that we bring in our oil from abroad because we don't have pipelines that go across the country. Choppy trading, this deadline imposed by U.S. President Donald Trump of 8 p.m. Eastern time, unless Iran comes up with a solid proposal agreeing to a ceasefire, then he'll go after that nation's infrastructure. In some ways, Vladimir Putin is happy here. Russian oil prices have hit the highest in more than 13 years. And of course, that's a major export for Moscow, the country's biggest export. The country's Urals crude topping $116 in the past few days. And Russia's actual government budget assumes $59 US. The one thing, though, the Ukrainians have been trying to spoil the party for Putin with their attacks on oil export infrastructure. And let's have a look at gold. Gold well off its record highs, but it's had a magnificent run. It's still up more than 50% in the past year. So far this calendar year, gold is up about 8%. Silver has been cooling its jets after its own magnificent run-up. It is flat now for the year so far. Let's have a quick look at one stock of interest here, Savaria. Now, they make stuff for modifying vehicles, so people with mobility problems can get around better. Home equipment to help people, again, who don't move around that well. Obviously, a demographic play. That stock trading right now. You can see it's down a little bit today, but it has been hitting record highs this week. Let's get over to this big story in music. Billionaire investor Bill Ackman is proposing a $65 billion US deal for Universal Music Group. This would combine the world's biggest music company with a US-based acquisition vehicle. We've got more from Neil Campling of Bloomberg News. Thanks very much for joining us. So in theory, Bill Ackman offering a huge premium here for Universal Music.
Yes, in theory, it's a very large premium. However, there are a number of assumptions within this particular deal, some of which is to actually effectively combine to put UMG with a US listing. But what it would also do is to put some leverage, some debt onto the balance sheet of Universal Music. And it makes some big assumptions there in terms of a 25 times price earnings multiple, which is higher than any European media company, and also doesn't take into account the fact that UMG has a low cash conversion relative to its peers, and a music industry which in terms of growth rates is slowing down.
And not a huge reaction as far as I can see in Universal Music stock. It is up almost $2, but not a surge anyway. Or €2, sorry.
Exactly. And I think, again, that's reflecting the fact that there are other factors at play in this particular deal. And also there are a number of hurdles in terms of trying to get this deal over the line. And those hurdles are in terms of regulation, because of course UMG is already the world's biggest music label. There is the fact that you would have to get shareholder approvals, and that's one of the big stumbling blocks here, because in the French Bolloré and Vivendi and related parties own nearly approximately 28% of UMG, and that's going to be a big stumbling block to get any kind of transaction over the line.
And Neil, we've less than a minute, but I think you referred to this slowing growth in the industry. AI on Spotify is attracting revenue and big sales.
Yeah, that's exactly true. In terms of AI is perceived to be a potential threat to the labels and the artists, performing artists of UMG to an extent, and Spotify has actually done a good job in terms of incorporating AI into some of the creation technologies, but that could undermine, if you like, the opportunity for music and content creation on some of the labels. And also, the transaction that's being proposed also does mean that an expectation that Spotify's stake that owned by UMG will be sold in such a transaction.
Thank you very much. Neil Campling of Bloomberg News. Coming up, shares in Broadcom got a boost after the company made a deal to sell devices to Google. We'll have more from Nick Mersch after the break. Welcome to the second hour of The Open. Let's get to the stories we're bringing you from our newsroom. Home prices in Canada's largest city have fallen to their lowest level in more than 5 years. Data from the Toronto Regional Real Estate Board indicates that the benchmark price of a home in Toronto dropped 0.6% in March from the previous month to hit the lowest since December of 2020. Meanwhile, the supply of listings remained elevated. However, the number of homes being sold in March increased for the first time in 6 months. Shares in Pembina Pipeline edging higher. The oil and gas company expects to deliver up to 7% profit growth annually through 2030 on a per-share basis. Pembina will be supported by annual fees, higher utilization of existing assets, and contributions from new projects. The Calgary-based firm says its long-term growth plans include investments in LNG, liquefied petroleum gas, and emissions reduction infrastructure. And here is another look. There is the TSX Composite. Let's take a look, though, at shares in the big U.S. health insurers, such as United Health Group, Humana, and CVS. They are higher after the U.S. government said it will pay private insurers close to 2.5% more in 2027. According to the Centers for Medicare and Medicaid Services, the policy is expected to add more than $13 billion US in additional payments to Medicare Advantage plans next year. TSX under pressure in early trading, even though oil is up, trading around $115 amid fears of further disruption in the Strait of Hormuz. And let's check out the U.S. markets. And you can see they are drifting down. Shares in Broadcom are getting a lift today. This is a semiconductor company. It has announced a long-term agreement with Google to develop and supply devices responsible for running faster and more energy-efficient large AI models. The companies are also working with Anthropic to power that company's growing operations. We're joined by Nicholas Mersch, Portfolio Manager at Purpose Investments. Nicholas, always great to see you. Thanks very much indeed. So these are tensor processing units. Google apparently invented them, and they help machines to learn ever faster.
Yeah, that's right. This industry is so filled with fun acronyms. And this headline this morning is really, really exciting because what an awesome time to be investing in a lot of these technology companies. And there are so many hidden nuggets in this headline. So the first one is that you can really see is Anthropic's revenue growth. So they were at a $9 billion annualized revenue run rate at the end of last year. And over only the last 3 months, they've grown this to $30 billion in run rate. So if you want your return on artificial intelligence, how about that, going from 9 billion to 30 billion in the span of 3 months. And everybody that I talked to is really using these tools, really implementing them on a global basis. And what's happening here is you're seeing this spike in usage, this spike in inference. So you have to keep up from it from a compute level. So the first read through here is really, again, that massive revenue increase that we're seeing locally at Anthropic. And the second was that headline figure of 3.5 gigawatts. So they're extending this build out from 1 gigawatt in 2026 to 3.5 gigawatts in through 2027. And what this is really showing is that there's no sign yet of this infrastructure build out really slowing down. We've got some of these indexes showing down pretty moderately on a year-over-year basis, but underneath the surface, the secular demand driver is very much alive and well. And what this is also showing is really one of these validation points in terms of an alternative to NVIDIA, right? So these Google TPUs. So Broadcom saying, hey, if you're a hyperscaler, you want to build some custom silicon, instead of having so much pricing power towards NVIDIA, come work with us. We'll build your custom silicon and really go out and make an awesome product. Now, the market got a little bit worried about this earlier when Google came out with one of these frontier models that really smashed it on a lot of these different kind of benchmarks across the boards. That was all built on a TPU. So they're back again saying, look, this worked very, very well, and we're going to produce more of these. So really exciting headline with a lot of read-throughs overall.
And Anthropic, not public yet, but that could be a gigantic IPO?
Yes, absolutely. So there's kind of the 3 mega IPOs in the pipe right now. The SpaceX one, which keeps kind of creeping up in terms of the valuation from 1.25 to now 1.75 trillion, which is a whole discussion on its own. But we've also got Anthropic and OpenAI. Now, OpenAI has a lot of headlines recently about the kind of turmoil going on in terms of their CEO and CFO disagreeing about capital allocation decisions and timeline to go public. But Anthropic is looking very, very clean right now in terms of the narrative is picking up speed. A lot of people are migrating over from OpenAI onto Anthropic because Anthropic, what they did was right off the bat, they addressed the enterprise specifically. And they said, okay, here's the coding use case. We're going to be killer in that. OpenAI just had so many of these different side projects, Sora, their video editor, enterprise e-commerce solutions. And they shut all of them down, capitulating on that in a massive way. So people started to say, hey, look, we need some more strategic direction here at OpenAI, and they're not seeing it. On the other hand, Anthropic is showing it in spades. So really winning in the battle of the big LLM companies here.
Have you been a buyer of Broadcom lately, Nick?
Yeah, Broadcom, I love in this space. And the whole kind of adage in semiconductors is in Hawk we trust. So there's kind of rock stars in semiconductors. Jensen at NVIDIA is one. Hawk at Broadcom is another one. And Broadcom here is really, again, providing that alternative, saying, okay, we can partner up with a lot of these major AI companies and go in and start to kind of steal some of that pricing power away from NVIDIA. And when you look at Broadcom, they've also got these major customers like Google. They've got Anthropic. They've got Meta. They've got got OpenAI, and they have two unnamed customers, which are probably ByteDance and Apple, but they've got some pretty great customers in the queue there. Now, where NVIDIA can kind of come back against this is they just made a pretty solid acquisition with Grok. And Grok, what they do is master on the inference side. So remember, in artificial intelligence, there's the training of the original model and there's the inference, so using that model itself. So NVIDIA just partnered up with a company called Grok to also do some boosting on the inference side, but it looks like the Google stack here is doing very well too. So you've got the Google stack kind of versus the OpenAI stack on the other side. So interesting to see how it all plays out.
Is that Elon Musk's Grok?
No, so this is a different Grok.
Oh, a different thing.
And
okay.
It's confused by the name. So there's Grok from Elon Musk is the Grok, and the Grok is Groq, which is what they called their chip. It was an LPU, so a language processing unit that really mastered getting inference out there very quickly. So what they're starting to see is it was a very sort of staple when NVIDIA went out during their GTC and they had their big conference and were talking on stage that everything is moving towards inference. Calling these models over and over again, because that's where you get a lot more efficiency boosts when you think about the overall capability of these models. So Grok is this chip. They work on the hardware side. It was kind of one of those acqui-hires, so they can get around some of the sort of anti-competitive regulations, but they're on the hardware side.
We're very tight for time. What about Celestica? The stock is down about 16% from November. Would you be a buyer of it right now?
Yeah, Celestica fits perfectly into this overall, and it's one of, I think, the best ways to play this sort of AI enablement from the infrastructure perspective at scale in the Canadian market, right? So they're not building the chips, they're building the switches, the racks, the interconnection, the stuff that doesn't get headlines, but without it, none of this really works. So there's massive movement going on in data centers around scale up, scale out, and scale across when it comes to within the rack, between the racks, and then also between data centers, and Celestica is a player in this space. So they've publicly confirmed Google as the preferred manufacturing partner for these TPUs, these tensor processing unit-based systems. So Broadcom designs the TPU, Google owns the architecture and deploys the cloud infrastructure, and Celestica builds these systems. So they're immediately involved in this ecosystem. So as soon as you have, again, that upgrade in terms of more build out coming, it all flows through to Celestica, which I think is a great way to play it, especially because it's pulled down here lately.
Thanks very much, Nick. Always great hearing from you. Nicholas Mersch, Portfolio Manager at Purpose Investments. Coming up, home sales in the Greater Toronto Area have shown an increase after months of weakness, but prices have hit a 5-year low. That's ahead. Home sales in the Greater Toronto Area showed signs of life in March. There was an increase after months of weakness, 6 months. Prices, though, came under pressure, and we did see the benchmark price hitting the lowest since late 2020. We're joined by Jason Mercer, Chief Information Officer at the Toronto Regional Real Estate Board. Jason, great to see you.
Morning.
Talk to us about the latest month. We did see an upturn in sales activity.
Yeah, we saw a bit of an uptick, certainly on a year-over-year basis, but then after seasonal adjustment on a month-over-month basis as well. And I think we're starting to see a little bit of response to improved affordability over the past year. So we've seen home prices trending downwards as well as borrowing costs by and large. And so there's a lot of households that have been on the sidelines that are saying, when I look at that monthly mortgage payment relative to my income, things have improved a lot, and I can also take advantage of substantial negotiating power that's in the market today.
But the broad home price, the benchmark home price, which of course is a very broad measure, there's so many different types of housing, hitting the lowest since late 2020, the price.
Yeah, and I think that's, again, just sort of representative of the choice that many home buyers operating in the market today have experienced over the past year, really couple of years, in the sense that even with sales ticking upwards in March, we're seeing inventory levels, much higher than what we consider normal, whether you're looking at, new listings coming into the marketplace or active listings. And so when you have that kind of choice, that type of negotiating power, that continues to impact price.
It's interesting we haven't seen more of a recovery in price, maybe because we've had quite a lot of interest rate cuts in Canada.
Yeah, and so if we continue to see the trend that we saw in March, where with sales up a little bit and new listings actually trending lower, we'll start to eat into that standing inventory, those active listings that we measure at the end of each month. And so if we see that for a few months, that could provide a little bit of support for pricing as we move into the second half of this year.
Is it the condos? Are they the main source of price weakness?
Well, if you think about where we've seen a lot of the new construction completions over the last couple of years, that's certainly been in that condo space. And so as units have completed, you've seen investors that have been looking potentially to sell. You also have the scenario where during the construction period, you have end users that had every intention of moving into that condo. Perhaps their situation has changed, and so those units get listed for sale as well.
We've heard talk of a condo crisis. I mean, are a lot of units just sitting there with owners who'd like to sell but can't get the price they need?
Yeah, it's interesting. When you think about the new home construction market, and particularly condos, you have some that are pointed at end users. So you have investors that purchase them off of plans and sell them to end users upon completion. But you've also seen a lot of the units pointed at the secondary rental market over the past number of years as well. And so as we've seen, the dynamic shift in terms of temporary migrants and what have you in Canada, that's also impacted the rental market. And so, that's also fueled the number of listings we've seen come online as well, because the prospects on rental haven't been as strong.
In retrospect, was it a mistake to build so many small condos?
Well, I think, when you think about what the formula was in order to get a project off the ground, you needed to see investors purchase those units off of plans and essentially act as wholesalers during the construction period, and then either sell to a retail buyer, an end user, or rent that unit out upon completion. I think certainly moving forward, when we're thinking about the type of housing we need, that sort of missing middle housing, plexes, stacked towns, et cetera, that can bridge the gap between, say, traditional single-family homes and condo apartments. Perhaps we need to look at a bit of a different formula in terms of how we underwrite that construction financing and what have you.
Yeah, that model of selling to investors or speculators left us with a lot of very small units.
Yeah, and I mean, we've seen the willingness on the part of the federal government and provincial government to look at new policies pointed at the new home market. Obviously, we've looked at HST, we've looked at development charges over the last couple of weeks. I think there's also the opportunity to perhaps look at where we go in terms of underwriting, especially on the construction financing side. If we're looking to see development pointed in a certain direction, that could be on high-rise condos of larger units. It could also be, again, in that sort of missing middle type construction, so potentially wood frame construction at that sort of mid-rise level, both in existing neighborhoods and in new developments as well.
Sorry, what was that about wood frame construction?
Yeah, so I mean, if we think about the type of housing we need to see moving forward as construction picks up, again, it's that sort of missing middle, that mid-density type of housing that bridges the gap between condos and single-family homes. And a lot of that, we could shift to that sort of wood frame type of construction, or even modular construction that sees these units come online much more quickly than, say, high-rise concrete.
Yeah, apparently Mattamy Homes, Peter Gilgan, is all over this. He's very interested in the prefab homes, the modular homes.
I think it makes sense. Like, as we've seen, the policy shift towards, this type of home construction, I think now we'll start to see innovation in the space as well. What's the best way to bring this online? Is it factory build, modular, truck it to the site, or is it build with traditional wood frame? It's probably some combination thereof.
And I'm not sure that you're not a construction guy as such, but townhomes how do they compare to a semi-detached?
I think, when you look at townhomes, it's a little bit more efficient than building a semi, because you'll have a row of those units, and there's more common walls. And so it just makes that construction of low-rise homes that much more efficient. And then you can also verge into that stacked town category, where it's kind of a hybrid between a townhome and a condominium apartment as well.
And has there been real significant progress on these development charges? I mean, Toronto is notorious. We've heard that it can add $100,000 to the cost of a new home of the various levies from the city.
Well, I think, if you're looking at, the federal and provincial governments sort of taking up the slack on that, and that gets passed through to home buyers in the form of savings, that'll certainly help in terms of, bringing online the type of homes that people need over the long term. And if you think medium term, we haven't seen a lot of pre-construction home sales over the last couple of years. And so that means as we eat into this inventory of resale housing, market conditions could tighten up again unless we start to see home types that can be built a lot quicker come online.
Jason, thanks very much.
Very welcome.
Jason Mercer, Chief Information Officer at the Toronto Regional Real Estate Board. Up next, in this unpredictable environment, oil spiking, some tech stocks under severe pressure. We're going to track ETF trends. Where are people putting their money in exchange traded funds? We'll be right back. Let's take a look at some ETFs. In some cases, we've been seeing substantial inflows, but generally, these are ideas that people have been exploring in the market. We're joined by Valerie Grimba, Director Global ETF Strategy at RBC Capital Markets. Thanks very much indeed for joining us.
Thanks for having me, Andy.
Let's look at one ETF that has been drawing attention, and it's the First Trust Vest Fund of buffer ETFs. Just remind us what buffer ETFs are. And the symbol on this one is BUFR.
Yeah, so buffer ETFs or defined outcome ETFs do exactly that. They provide a defined outcome. So you are structuring a series of notes within the ETF that limit your downside to a certain level, but of course you're probably trading off some upside to provide that buffer or that outcome period to the downside. And so I would say that these are kind of coming back into the zeitgeist right now because, you know, there's escalating conflict. This harkens back to 2022. This is a period when we saw the stock and bond inverse correlation break down. So 2022, of course, stocks were down, bonds were down. We saw that happen in March 2026, so most recently. And I think investors or asset allocators are looking at other alternatives to kind of solve for that solution in their portfolios.
And does this one give you a play on the stock market?
Yes, yeah, these buffered funds are built around the S&P 500, so they're going to be setting certain levels on the U.S. equity market. But again, it's kind of about capital preservation and looking at other ways to kind of offset or diversify within a portfolio.
Right, but there can be a cost. You are giving up potential upside.
Absolutely, yeah. There is a trade-off, but again, if you're looking at a certain sleeve of your portfolio that you kind of want some conservative outlook or capital preservation, these look very interesting, especially if bonds are falling as well as stocks.
Here's another one, BALT, the Innovator Defined Wealth Shield, and the idea here is to protect against the situation, perhaps inflation, in which stocks and bonds are dropping together.
Exactly, and this is the large U.S. one, and I often use this one as reference because the ticker is excellent. BALT stands for Bond Alternative, B Alternative. So again, if you're looking for something in your portfolio for that conservative allocation, or if you think we're going to go into an extended period of market weakness, this ETF is designed to kind of hedge against that.
Asset allocation ETFs are popular. You guys, you've got a big ETF family. Easy is one from RBC, and then King, KNGG. Remind us how these work, please.
Yeah, so Easy is brought to you by Evolve ETFs.
Oh, I'm sorry.
But we help launch it, and we're the designated broker on the fund.
Okay,
so we're trading the lead market maker on the fund.
It's not an RBC product.
Correct. It's Evolve ETFs. Yeah.
Sorry, carry.
That's all right.
Go ahead.
Yeah, so we're seeing, kind of the all-in-one ETF solution has really taken off here in Canada. Investors are really clamoring for this. This really is the easy button, the kind of set it and forget it. And these are ETFs of ETFs. So the idea is it's a single ticket solution, but you get access to a variety of underlying ETFs. So Easy is, again, kind of a generating yield play, and it owns a variety of different Evolve ETFs in the Easy ticker. And then KNGG is brought to you by Brompton Funds. And same thing, it's holding 3 different existing ETFs within the one ticket solution.
Have you had pushback from clients on these enhanced yield ETFs? Because in quite a few cases I've noticed they've underperformed the straightforward stock index.
It really just depends what the end investor is looking for. Again, I don't think any of these solutions are inherently good or bad. It's just solving a problem and meeting an investor's needs. And so I think the Canadian investor is telling ETF issuers that there still is a strong demand for yield, and that is a very much focus. And so these enhanced yield products provide that to the end client.
I guess my bias would be, though, just owning straight stock ETFs and just liquidating some of it every month or every quarter for income, but each to their own, I suppose.
Yeah, but then you just kind of described the digital friction points. You have to be diligent about doing that, have the wherewithal to do that, and do it on a regular cadence to kind of keep that. But an ETF can kind of solve for a lot of those problems for you, and it's less to do, really.
Okay. And then finally, an idea in energy, HOU, the beta crude oil inverse XX leverage. So this is a play on oil prices dropping.
Correct.
But is this one of these that you really should think about trading on a very short period?
Yes, this is definitely for the sporty or athletic trader. You're only going to be using this intraday, really holding this maybe 1 or 2 days maximum. I highlighted it because trading volume is through the roof. On HOD, this is the most traded Canadian listed ETF.
Oh, this is a bull one, is it?
HOU is up 2x the upside, and HOD is to the downside.
Oh, I think I said inverse. So this is the bullish one.
This is the bullish one, maybe on screen, but HOD to the downside. Obviously, traders or people are trying to position. They think this oil price is looking too frothy right here, and it owns the front month contracts. It's been a tough trade. It's traded, like the volume is up a lot, but I mean, obviously, we've seen sticky oil prices. So yes, you're better off owning the HOU right now. But
right.
Traders are trying to bet on the retracement there for front month oil.
But I guess we should repeat the traditional warning. These are really just for holding for a day
Absolutely.
or two. Yeah.
These are short-term trading vehicles only.
Valerie, thanks very much indeed.
Great. Thank you for having me.
Valerie Grimba, who is the Director of Global ETF Strategy at RBC Capital Markets. Up next, the markets focused on U.S. President Donald Trump's deadline for Iran. And we have seen oil trading at around $115 US. We'll have more after the break. Home prices in Toronto in March fell to their lowest level in more than 5 years, according to data from the Toronto Regional Real Estate Board. The benchmark price of a home in Canada's biggest city dropped 0.6% from the previous month to hit the lowest since December of 2020. So home prices were down and the supply of listings remained elevated. However, home sales in March increased for the first time in 6 months. Still on real estate, Boardwalk, a real estate investment trust, has sold 4 properties for a total of $105 million as part of its capital allocation strategy. And the trust bought back more than 1 million units for $66 million in the first quarter of 2026. The Calgary-based company says its portfolio occupancy remains strong at around 97% as of April. Billionaire investor Bill Ackman is proposing a $65 billion US deal for Universal Music Group. His firm is pushing to combine the Dutch-based music company with a US-based acquisition vehicle. The pitch puts on paper a 78% premium to Universal's last closing price, but there hasn't been a commensurate move up today in Universal Music. The deal would force through a U.S. listing that Universal has so far delayed. This is the world's biggest music company, and it houses artists such as Taylor Swift and Drake. A look at North American stocks, and you can see they are drifting down today. Nasdaq off 1%, even though Broadcom has rallied on a big deal to sell devices to Google. Investors around the world are awaiting 8 p.m. Eastern Time. That's when U.S. President Donald Trump's latest deadline for Iran expires. The president has warned that unless he gets a satisfactory response from Iran on a ceasefire and the reopening of the Strait of Hormuz, he plans to attack Iranian infrastructure. We got more from Bryden Teich, Chief Investment Officer at Avenue Investment Management.
It feels like what's happened in the last week is the market has increasingly ignored all of this, assuming that there's no way to gauge because we've had now the deadline changed multiple times. Like, if you listen to what Iran is saying, they're saying, we don't agree to any of this and we're not talking.
Yeah.
The U.S. is obviously, administration is much more incentivized to try to normalize transit through the strait because of the impact on global energy markets. And I think we're now, or the market is at a standstill, just waiting to see what happens with the U.S. Because Iran clearly is.
Well, and they were up, so we're just looking at them right now. The futures, they were up slightly earlier. So, I mean, what spooked them now?
And I would even say Iran's sort of, it's pretty clear to see Iran's playbook, which is, of course, Iran cannot militarily match the U.S.
Yeah.
They've essentially, they're holding a grenade, they've pulled the pin, and if Iran is attacked, they are going to attack Gulf state infrastructure for the energy market, because that's all that they can do. And that's, would be a disastrous situation for, Iran's neighbors and also the U.S. and I think consumers in North America and in Europe and Asia, where you're already seeing the impact felt the most. So I think it's important not to dismiss this. There's a lot of sort of, kayfabe theater going on with this.
Sorry, what'd you call it?
Kayfabe. That's what wrestlers do. So it's like, have you ever heard that term? Kayfabe?
Never heard kayfabe.
Yeah, so this is what I would, there's a lot of kayfabe going on here. But you cannot dismiss the fact that, we are one escalation away from things really spiraling out of control. And I think investors have to be treading cautiously with all of that in the background.
And I think that's part we like, the kayfabe?
Kayfabe.
Kayfabe.
Yeah.
We kind of laugh at that, but at the same time, it's a very serious situation, but it's so surreal.
Yeah.
And it really is hard to figure out what the next move is.
Yeah, and I think it's sort of alarming, and you can almost become numb to it. And I think what I was sort of starting with is that investors have sort of become numb in the last week. This is a really live situation, and I think it's wrong to think that everything's going to go back to normal and there will be some kind of peace deal quickly. And I think it's also wrong to be extreme, hyperbolic. This is going to be nuclear Armageddon in the next 2 months. I think either of those are extreme, but you have to be open and sort of be looking at the field wide from an investment perspective, because we don't know what's going to happen here in the next.
It's reminded. Now we're into all these visuals. It reminds me a little bit of Animal House, Kevin Bacon's character. Everything's going to be okay as he's getting run over. Long term, it will be, but right now. So how are you approaching this? What are you doing?
So I wouldn't go as far to say as we've been preparing for this, but we've been watching the situation emerge over the last couple of years. I think we were very alarmed last summer when the U.S. started bombing Iran, and we're almost surprised at how quickly that was sort of resolved from a market perspective. But the U.S. and Iran have been hurtling towards this for, you could say, decades. But investing obviously doesn't occur where you're waiting for these events to happen. And so I think we've been alarmed at the escalation in the last month. We think that there's multiple paths on which this goes. We're not trying to predict which one. We're sort of, again, just trying to be open-minded to all the different outcomes. But I think in the near term, no matter what happens, we're in a situation where you're starting to have physical oil shortages in Asia. I think we're probably a week away from that in Europe. North America is immune because we're such a large producer, but
for now at least,
prices are rising. Yeah. I mean, if gas prices are up to $1.80-ish in the GTA, they were $1.25 a month ago. Yeah. I mean, where do we go from here? $2.50, $3? The question then becomes, at what level of demand destruction does it take for the economy to really bite? And we're probably going to figure out in the next month, because even if this is resolved, I think there's this now supply bottleneck, physical commodity shortage, where you're seeing that. I think even in Italy, they were rationing jet fuel the other day.
Yeah. Well, didn't England, the UK get their last shipment of jet fuel? Just came in?
Yeah.
So they've got about a month, apparently?
So we're right up against that. And I think even if the strait were to reopen in some way in the next few weeks, that bottleneck from last month, it's going to take another month for that to flow through. And so the physical tightness in the energy markets, I think, is sort of the story that will emerge in the next few weeks.
And I mean, we are going to see the spillover from Asia, from Europe, coming here. Maybe, we might not have oil shortage, but people will have to start making decisions about if they're driving, how much they're driving, where they're going, what they're doing, and then prices for things that are coming from elsewhere or things not coming in at all.
Yeah, absolutely. I think because it's happened, prices are up here at the pump. They're up in the U.S., but they're not up, that much more than they would have been in 2022 when Russia invaded Ukraine. I think people haven't gotten the sticker shock yet, but another 20, 30, 50% from here in terms of gas prices, I think you really start to bite, and I think consumers then have to make those tough choices.
Bryden Teich, Chief Investment Officer at Avenue Investment Management. Coming up at Hot Picks, we're going to check out 3 names in travel and leisure, including one on the high seas. That's after the break. On Hot Picks today, we are talking travel and leisure. Our guest has a cruise line as his number one idea. He says the industry is showing strong momentum and Carnival stands out from its peers. Let's get more from James Hardiman, analyst in U.S. leisure and travel at Citi. Thanks very much indeed for joining us, James. Really appreciate it. Carnival, what attracts you to this stock?
Yeah, so we've been a big believer in the secular opportunity for the cruise industry for some time now, and we can talk about that if you want. But I think more near term, this is an industry and a company that's gotten hit hard as a result of the Middle East conflict. And I think that's for 2 reasons. One is the cost side, right? Fuel is one of the biggest, if not the biggest, expense line item for cruise companies. And Carnival in particular is unhedged. And so they've gotten beaten up because of that. And then 2 is the demand side, right? The belief that travel is going to be negatively impacted by the Mideast violence, right? And so obviously we're still wading through the first. Certainly on a day like today, it's hard to feel like we've found a ceiling in terms of fuel prices. The latter has been really good. Demand has been really strong. As a matter of fact, they raised their top line guidance when they reported a week and a half ago. And then on top of that, it's a great capital return story. They've now laid out about $14 billion of shareholder returns between buybacks and dividends that they're going to pay out over the next few years. And they've just opened a new private island, Celebration Key. 2026 will be the first full year of that benefit. And so I think if we can sort of take a step back and think that some of the Middle East conflict will eventually subside, everything else is going exceedingly well for this company. And, those higher fuel prices are already factored into numbers at this point. I think there's a lot of reasons to believe that the future is bright for a company like Carnival.
Right. You probably heard the old joke, a boat makes you happy on only 2 days, the day you buy it and the day you sell it. They are expensive to run. But anyway, you like the look of Brunswick, a big seller of marine recreation products.
I do. And I think it's been a rough, 3 or 4 years for the company. I think the combination of inflationary boat prices and then higher for longer interest rate has really hurt this company. We went into 2025 thinking that, we could finally see a rebound. And it seemed like it was heading that way. And then Liberation Day happened. And I think that had a pretty negative effect on demand. Second quarter was down double digits in terms of retail. What we've seen since second half of last year flattened out. First quarter of this year, we've started to see some growth. We think sort of mid-single digit growth in the first quarter. Then we'll get to lap the Liberation Day fall off. Certainly, if we can get to mid-year with some decent growth during the first half, I think there's meaningful upside to numbers. And that's ultimately what I think you're playing for, is that we've finally seen that bottom that we've been waiting for years to see.
And then finally, DraftKings, a big player in sports betting.
Yeah. So, I mean, online gambling and specifically online sports betting is very much a growth industry. And I think DraftKings is one of the, 2 companies on earth best equipped to capitalize on that. What's gotten lost, I think, over the last 6 to 9 months is, prediction markets have really been in the headlines, right? And the bear case is that prediction market players like Kalshi and Polymarket are going to take all the business or most of the business from the traditional online sports books, right? DraftKings and FanDuel. The bull case is that the online sports books are superior in terms of their offerings. And so those prediction markets are never really going to make too much progress. Our thesis is a bit more nuanced. We think there's going to be some cannibalization in those existing markets, which make up, call it 60% of the U.S. population, but that there's a bigger opportunity to be gained from these prediction markets in the unregulated states, right? 40% of the U.S. population still doesn't have access to online sports betting. And this is in a lot of ways a Trojan horse into those markets. So we think it's a big opportunity. You know, there's a lot of legal challenges brewing, which is a whole other subplot here. But we think these companies have positioned themselves in either scenario, whether there's prediction markets, you know, whether those are legal or not, to really be successful.
It's amazing, isn't it, James? We're almost out of time, but this explosion of gambling, prediction markets, you name it. And there are worries about social harm here. I know I'm getting a bit off topic, but some people are overdoing it, apparently.
Yeah, people are overdoing it. And I think these prediction markets in particular are it's early days and they're unregulated, right? And we've spent years, decades trying to sort of make sure that the proper guardrails surround traditional gambling and online sports betting. Well, now you've got this whole new product, which, for all intents and purposes is gambling, and there really aren't those rules around it. And so I do think there's a lot of work there that needs to be done to make sure that this is safe for the public.
Thanks, James. James Hardiman, analyst in U.S. leisure and travel at Citi. Coming up, the world anxiously awaiting the next development in Iran. President Donald Trump renewing his threat to attack Iranian infrastructure. We'll have more after the break. Know Your Options is back. Tune in tomorrow at 3 p.m. Eastern to get all of your options trading questions answered by Chris Tom of Moat Financial. Send your questions to knowyouroptions@bnnbloomberg.ca. The world is standing by for U.S. President Donald Trump's next actions if Iran doesn't come up with a proposal that satisfies him on reopening the Strait of Hormuz. The president has set 8 p.m. today, Eastern Time, as a deadline. We got more from Stephen Cook of the Council on Foreign Relations. He spoke with our partners at Bloomberg News.
Stephen Cook on the Council of Foreign Relations writing, mediation is at a dead end. Iran has no reason to give up control of the strait. The Iranians believe they are winning. Stephen joins us now for more. Stephen, always wonderful to have you on the show. I'm just wondering how likely you think escalation is by 8 p.m. tonight.
Well, I think it's quite likely. The gulf between the United States and Iran is very, very large. The president has said that the Iranians have to open the strait, give up their nuclear weapons, give up what remains of their missile program, and end their support for proxies. At this point, the IRGC leadership doesn't believe that it needs to do any of those things, particularly when it comes to the Strait of Hormuz, something that gives them far more leverage now than before even the war began in late February.
What can escalation actually look like, given the fact that there's a lot of pressure from the GCC nations on the United States not to attack some of the critical infrastructure that could potentially engender retaliation, the likes of which they've already seen?
Yeah, the GCC states have said that they want the president to finish the job, but they are very, very concerned about the Iranian ability to strike back at their own energy infrastructure, their desalination plants. These are essentially city-states, with the exception of Saudi Arabia, that depend on this kind of infrastructure, desalination plants for fresh water, for large and growing populations. For the Iranians to attack them would be devastating. So I think that the president is poised to escalate. And he seems, at least publicly, to be ignoring these concerns by threatening Iran's civilian infrastructure as well. It could get very ugly for the Gulf states, however.
Stephen, in the meantime, you point out that there's a new regime for passage through the Strait of Hormuz. What does that look like?
Well, the Iranian leadership has successfully closed the strait, or at least partially closed the strait, and now governments are appealing to the Iranians to allow their flagged tankers and other ships to go through. Most recently, the Japanese have reached out to the Iranians to see if they can make some sort of deal. The Filipinos have done the same. The Indians have done that as well. This gives the Iranians leverage over the strait that they never had before. There has been the Turks have floated the idea of an international consortium to manage the strait, which would include Iran. This implies some sort of tolling mechanism like you have with the Suez Canal. This gives the Iranians power that they never had before.
Stephen, does it seem like the U.S. would be part of those conversations? Because at the moment, as you lay out, Japan, Turkey, the nations reaching out seem to be excluding that of the U.S. You even had Emmanuel Macron talking over the weekend about teaming up with middle nations to counter some of the U.S. power. Is it possible that we get a new regime through the Strait of Hormuz that excludes any say from the U.S.?
Well, to the extent that the Iranians have the most say, as they do right now, it would exclude the United States. Ostensibly, under some multilateral mechanism, no country would be excluded from passage to the strait, although revenues from it would accrue to the benefit of the Iranians. I'll point out that yesterday during his press conference, the president said that he would be interested in tolling the Strait of Hormuz as long as the tolls went to the United States.
I'm struck by the scenario that you're painting, and frankly, all the geopolitical strategists and commodity strategists we have on the show who paint a pretty dire backdrop without really a clean answer or exit to the conflict that we're seeing right now. And then I look at markets that are trying to look through it. I think about people come on and they say, it'll be over, it'll be in the rear view mirror come September or October. Can you square the spread there and understand exactly why this mismatch in sentiment?
I think the idea that we'll be beyond this relatively soon is purely speculative. There is a reason why 5 or 6 previous presidents have been shown the war plans for Iran, have decided not to do that, have either sought negotiations or containment and deterrence. The fact that the Iranians have closed the Strait of Hormuz shouldn't have been a surprise to anybody. This is the first thing that they do. This is a regime that has its back against the wall, that the president has threatened to bring down. So I think that the Iranians, to the extent that they can, will have fight left in them, will continue to fight. And which is one of the reasons why the GCC states have said to the president not to end the war prematurely, because they don't want to live in a situation in which the Iranians control the Strait of Hormuz and can threaten them physically with their drones and missiles. I don't think it's going to end very soon unless the president declares a victory and goes home.
Stephen, what's a good outcome for the United States, for the GCC nations?
I think a good outcome for the United States and the GCC states is cracking open the Strait of Hormuz so that freedom of navigation is reestablished and that the Iranians are unable to project their power beyond their borders. That has become an increasingly tall order for the United States. I think that the president went into this thinking this would be a matter of weeks, and it is turning out to be a much bigger, more involved, more complicated military operation than he ever imagined.
Stephen Cook of the Council of Foreign Relations in conversation with our partners at Bloomberg News. To close out the show, I have an announcement. At last, I'm leaving. My last day at BNN Bloomberg will be Thursday, April 30th. Now, this really is a blank, heartless universe. There's no justice. I've been ridiculously lucky. I've had a horseshoe around my neck, wonderful colleagues, and a job that just has consisted of yakking on all day about stuff that I find fascinating. I want to thank the guests who have put up with my rambling questions, and control room colleagues and producers. Well, they have just been paragons of patience. And I want to thank you, the viewers, for your kind comments and support. People have come up over the years and said they like my work, a variety of people. And it's just wonderful talking to you. And often people are shy. Oh, he doesn't want to be bothered. I love it. My wife says I love it too much. So if you see me around, please do say hello. But I really want to express my thanks to my colleagues, in particular the producers, and everybody here, and to you for watching over the past 25 years. That wraps up this edition of The Open. Morning Markets is up next.